Imagine you're at a crossroads. On one side you have Warren Buffett's Berkshire Hathaway, no dividends, long-term growth, a fortress of fundamentals. On the other, OMAH, an ETF that mirrors Buffett's portfolio but sprinkles in something different, monthly dividends through covered calls. And then there's JEPI and JEPQ, rising stars in the dividend world, built for income but with different engines under the hood. So how do you choose? Or better yet, should you choose at all? Let's break it down. Think of Berkshire as the gold standard of long-term investing. You're buying access to Warren Buffett's brain and discipline. No dividends, because he reinvests every dollar for compounding returns. Over the past 2 decades, BRKB has delivered around 9 to 10% annualized returns, sometimes crushing the S&P 500. But here's the catch, you don't get paid along the way. No monthly income, you're in for the long haul. Now, OMAH comes in with an interesting twist. It copies Buffett's portfolio, top holdings like Apple, Coca-Cola, Chevron, but adds covered call strategies on top of it. That means it generates monthly income by selling options, potentially capping upside but handing you a regular paycheck. In 2023, OMAH's yield was around 7 to 8%. It's designed to offer both growth and income, though the income part is more consistent. It's not as aggressive as JEPI or JEPQ, but for Buffett fans who want dividends, it's a sweet middle ground. Now we're stepping into the heavy income zone. JEPI, the equity premium income ETF, is S&P 500 based, but uses equity-linked notes and covered calls to reduce volatility and pay monthly dividends. JEPQ does the same but focuses on the NASDAQ 100, more tech exposure, higher growth potential, and also more volatility. Both yield 8 to 11% depending on the market. They won't give you insane growth, but they'll deliver consistent income. That's their mission. If you're a long-term builder, you might love BRKB. You're not looking for income right now, you want the value of Apple, Bank of America, and Moody's to grow over decades. If you want growth plus a little cash flow, OMAH gives you exposure to Buffett's method with a little extra monthly reward. Not aggressive, not too soft. If you're an income-first investor, JEPI and JEPQ are your go-to ETFs. You're okay giving up some long-term upside because you want money now for bills, retirement, or reinvestment. Let's take a $100,000 investment. Here's how these options might have played out over 5 years. Assuming average returns and compounding BRK.B, at 9% annualized, would turn $100,000 into about $153,000. OMAH, with a 6% price return plus a 7% yield reinvested, would get you to roughly $149,000. JEPI, with a 2% price return and a 10% yield reinvested, could grow that to around $162,000. JEPQ, at 4% price return and 9% yield reinvested, would take you to about $164,000. These are estimates, but they show something important. Yield plus reinvestment can actually compete with pure growth. But if the market really runs hot, BRKB could outshine everyone. Dividends from OMAH, JEPI, and JEPQ are usually taxed as ordinary income. BRKB's value grows silently, you're not taxed until you sell. That gives Buffett's method a huge edge in taxable accounts. But in retirement accounts, income ETFs shine. No taxes on dividends inside a Roth or IRA. You can live off the income without selling a share. Covered calls cap your upside. If Apple stock surges 20% in a month, OMAH or JEPQ might miss most of that gain because the call options limited it. BRKB, on the other hand, catches every wave. No ceilings. So the trade-off is, would you rather have predictable monthly income or unlimited upside potential with delayed gratification? Investor 1, Olivia, age 32, the builder. She's got time. She puts $500 a month into BRKB, no dividends, no distractions. She's not touching it for 30 years. Retirement will be golden. Investor 2, Marcus, age 45, the hybrid. He wants growth but also likes seeing cash come in. He splits 50-50 between BRKB and OMAH. He reinvests OMAH's monthly payouts. Investor 3, Linda, age 61, the pre-retiree. She needs income now. She's 80% JEPI and 20% JEPQ. The yield covers her living expenses. She's not chasing moonshots, she wants sleep. There's no universal winner. Want pure growth and long-term compound magic? Go BRKB. Want a Buffett-style ETF with a twist of income? Try OMAH. Need income now with lower volatility? JEPI. Crave income with tech growth flavor? JEPQ. And maybe you don't choose one. Maybe you blend them. Imagine a portfolio that's 40% BRK.B, 30% OMAH, 15% JEPI, 15% JEPQ. You've got compounding, income, and balance. That's the real Buffett move. Diversify your strategy with discipline. So now it's your call. Growth or income? Reinvestment or redistribution? There's no right answer, just what fits your plan. Like Buffett says, the best investment you can make is in yourself. Maybe the second best is knowing why you invest. See you in the next one. Let's simplify covered calls. That's how OMAH, JEPI, and JEPQ make income. They do it systematically. It's great for steady returns, not for explosive gains. So, if you believe the market will be flat or slowly rising, covered calls are a smart strategy. If you expect big rallies, covered calls can underperform. Buffett doesn't pay dividends because he believes every dollar inside Berkshire can be reinvested at higher returns. He'd rather grow your wealth quietly than hand it to you now. But that works if you don't need income. Many investors do need income, especially in retirement. That's where dividend ETFs come in. They trade off some growth to give you cash flow. For someone like Linda from earlier, a dividend ETF makes more sense than waiting 10 years to sell BRKB shares. It's not about right or wrong, it's about what fits your life stage. Let's look at a rolling 3-year performance comparison. BRKB tends to outperform in strong bull markets thanks to no caps on upside. OMAH and JEPI do better in flat or sideways markets where income cushions lack of growth. JEPQ is more volatile due to tech, but in bull runs, it can shine, especially if tech leads. Standard deviation, which is just a measure of volatility, BRKB is about 20%, OMAH is about 15%, JEPI is around 13%, and JEPQ is about 18%. That means JEPI is smoother, while BRKB and JEPQ are bumpier but offer more return potential. You can pick the best ETF, but if you sell in a panic, it won't matter. BRKB requires patience. OMAH requires understanding covered calls. JEPI and JEPQ can feel like a safe place until yields drop or markets crash. Behavioral discipline is everything. If you can't sleep at night watching your portfolio drop 20%, maybe a smoother income ETF like JEPI is better for you. But if you love the thrill of the long-term game, BRKB is your ride. Here's a wild idea. Adjust allocations based on your outlook. In a bull market, maybe 60% BRKB, 20% JEPQ, 10% JEPI, and 10% OMAH. In a flat market, 40% OMAH, 30% JEPI, 15% BRKB, and 15% JEPQ. And for a bear market, 50% JEPI, 25% OMAH, 15% BRKB, and 10% cash. You don't have to go all in. You can rotate and rebalance as the environment changes. The best investors don't chase the highest return. They build systems they can stick with. Berkshire's strategy is about long-term wealth. Covered call ETFs are about consistent income. OMAH is the bridge. You can make any of them work, as long as you understand what you're trading off. Don't invest blindly, invest intentionally. And always ask, what's this investment doing for me? Thanks for watching. If you got value from this breakdown, like and subscribe for more deep dive ETF stories just like this. And remember, investing isn't about being flashy, it's about being free.